All right, what's going on, my money mavens and moolah misfits? It's me, Joe Knows Money, back with another Ask Joe segment, right? So, as you all know, when I get questions from people, I like to make sure that I answer it in the most robust fashion possible. But I'm also at a point where I like to make sure that other people can benefit beyond the person who I'm talking with, so that I like everyone to be able to be a fly on the wall, listen to the conversation, and then be able to ask questions in the comment section, right? So I have a special guest today, and the special guest had a question about life insurance. So I'm going to bring him on in a second, and then we'll dive right into our live. There you go. Earl, how's it going, bro?
Brother, no complaints, no complaints. How about yourself?
Oh, I'm doing fantastic, fantastic as can be. I'm
Excellent,
happy to
excellent.
have you on. All
And
right.
so I definitely
So,
appreciate the invite and thank you for using your intelligence to help us that are not as quite intelligent when it comes to the money and insurance.
hey,
We
man.
call on you, brother.
No, I appreciate it. I mean, that's really the thing, right? Is to make sure there's so much competing information out there, and you really have to be extensively trained in it to really make sense of it, no matter how smart you are, right? Because as you know, you can read something to the affirmative when it comes to life insurance. You can read something to the negative, and then you're left wondering, does it apply to your situation?
Exactly.
Right? So
Exactly.
that's why I'm happy to have you on and talk through it, and we can go as deep and in detail as you like, or stay as high level as you prefer. Right?
Perfect.
So let me ask you this, just so obviously you and I talked before, but just in terms of when you think about the questions you have about life insurance, right? First off, how did the questions come about? And then what would you say is your top question about life insurance? And then I figure we would dive in, and then we can just have a regular conversation about it.
Well, just it came about because just increasing the amount of life insurance that I have on myself, whole life, term life, which is going to be best. I'm a father of five, and so I have a wife. So in the process of thinking, I always tell you want to have a nice life insurance, leave something for your family. That's how you create the generational wealth. But then you look at, social media and you're hearing all these different things about how you can use whole life, ask the bank and you can borrow from your money and do things like that. So, just going in between those things. And I'll just say, I don't have enough background in it to truly understand that. So I'm always push out and call the expert. And my expert is Joe.
I love it. I appreciate it. Hey, you
Yes,
see the
sir.
banner I got there? Become your own bank, Infinity Bacon. Any of that sounds familiar? Secret
Yes.
strategy of the wealthy.
Yes,
Uh,
yes, exactly. And that's the pitch.
yeah.
That's the pitch. But then, you hear something that's totally opposite of that, saying that, a lot of times the accounts never come to fruition or, just so many things where you can lose out. And so, like I said, because I don't have a background in that, I think it's very important to reach out to people that know exactly what they're talking about.
No, I appreciate that. And I think that goes to this point here, right? Is one of the things I always share with people is make sure you consider the source, right? So oftentimes you listen to these YouTube videos or you read these books, and I always encourage folks to really think about, well, what is their motivation? What is their hidden bias, right? So as you know this already, but for those of you who are watching for the first time, that I have 20 years of experience as a certified financial planner, charter life underwriter. A lot of people don't know that I hold that designation as well, where you take, additional coursework to really become beyond proficient when it comes to life insurance, right? But I'm retired, so I don't have the bias when it comes to whether or not a person should utilize life insurance, because I don't have any financial gain that's tied to it, which is rare, right? Most financial people that you talk to who are, on the side of life insurance or are against it, they have some kind of financial tie to the outcome. So it's important that you know what a person's motivation is. That's important for me to say because I am retired. I am a financial planner, but I'm not your financial planner. You're in the abstract, right? Meaning people should always seek wise counsel that's individual to them, and I'll speak more about that. I also talked about the conflict of interest, right? So oftentimes these videos that you see online are really just sales funnel, right? Because these folks work for an insurance company or a financial services company. So they're creating a checklist. They're feeding you the answers to that checklist and saying, see, you answered yes to all of these. So therefore you must be in need of this type of life insurance, right? So let's talk about that a little bit more. So just to button up the piece of considering the source, can the financial influencer that you're listening to say the same? Can they say they don't have any conflict of interest? And can they say that they are actually financial planners versus just insurance people? Because if they're an insurance person, it's kind of like a person who has one tool in their toolbox, which is a hammer. Then everything else looks like a nail to them.
Okay.
Right? So, hey, you need your car fixed, you need life insurance. You need to send your, kids here, buy school clothes, you need life insurance. It's like, I forgot the question, but I know the answer is life insurance. Gotcha. That's the mindset.
Okay.
Right? So we're going to dive into what is life insurance, just as a broad overview, and then specifically what you need to look for to address the questions that you have. Sound like a plan?
Yes, sir.
All right. So before we do that, if folks haven't already, please like, subscribe, and share so that more people can get the answers to the questions when it comes to life insurance. All right. So what is life insurance? Quite simply, life insurance is a contract between an insurance policyholder, i.e. the owner, as well as the insurance company, and it's based on the premise of you paying premiums to the insurance company, and in return, they're going to guarantee upon your death a payout, right? That's as simple as it gets in terms of how life insurance works. The bigger question has to do with what is the function of life insurance? Well, it's really to provide a safety net to those who rely upon you financially. So when you think about it, that could mean that if something were to happen to you, to cover funeral expenses, mortgages, childcare need, college education, so on and so forth. So just to put it on the table, I'm a huge proponent of life insurance for those reasons that you see here. The question becomes, do you use life insurance to be your own bank?
Exactly.
Do you use life insurance for all these exotic things that people are promoting, or is it just another sales pitch? All right, so let's talk about the different kinds of life insurance that exist. Before we do that, any questions so far, or anything that you would like to add?
No, I think you are answering my questions because it's just so many different things that you see, unfortunately, on social media that's saying, you got to do it. This is how the rich get rich. This is how, they use their own money. And so, it becomes quite confusing once you start looking at so much.
So here's the interesting thing about that. What I share with people is that if you listen carefully, and I have a different kind of trained ear because I've been trained in sales for 20 plus years, right? To hear the nuances in what people are saying and also what they're not saying, okay. Right? So oftentimes when they get on social media, it's like, hey, I have this car, I have this house, I have these properties, I have all of these things. I just want to tell you about them, and then I want to tell you about this vehicle of building your own bank. And what they're insinuating is that one has to do with the other.
Okay.
When in actuality, if you listen to them, they never say, or almost never say, that it's a direct correlation to it.
Okay.
So then you're left wondering, okay, well, is life insurance the reason for your wealth, right? You buying a life insurance policy to create your own bank, or is it you selling life insurance that's responsible for that lifestyle?
Gotcha.
That's a big difference.
Yes.
Right? So the example I give is, imagine if Mark Zuckerberg got on our live right now and said, hey, Earl, you can be worth $100 billion like me because I signed up for a Facebook account and you can too. Now, is Mark Zuckerberg worth $100 billion because he has a Facebook account?
No, sir.
Or is he worth $100 billion because all of us have Facebook accounts?
That's exactly right.
right? So the same thing applies to life insurance. Is it because you have a life insurance policy or because you sell the life insurance policies that's responsible for your wealth?
Gotcha.
Right? So keep that in mind when you see those kind of folks on social media. So you have two different types of policies. You have the term policy, which is really simple, right? Easy to understand. Its term stands for temporary. Now, the life insurance policy can be in place for 10 years, 20, 30, or even 40 years. And you pay a lesser amount of money for this policy because it doesn't stick with you for a lifetime. When it comes to a permanent policy, there's several types, just so you know. I mean, each year it seems like they add to the type of permanent policy, which means it sticks with you for your entire life.
Mm-hmm.
You know, a generation ago, the only permanent policy that existed for the most part was whole life.
Yes.
All right. So because when they talk about building your own bank and all of that stuff, they're talking about whole life. That's what I'm going to focus in on today.
Okay, perfect.
All right. And so let's go first term and then we go through whole life. So term is designed to be a bridge to wealth. So if you die before reaching your full financial potential, the term is there to help fund what you would have been able to fund yourself if you were still living.
Okay.
So think about it. If you think out 2 years from now, 5 years from now, 10 years from now, you think to yourself, man, I'm making this much money now. Here's my earning potential over the next 10 years. Maybe I'll have this paid off. I have more money coming in here, or whatever the case might be. That plan of yours may work like a charm as long as you are here to facilitate that plan into fruition. However, if you pass away prematurely, then to have the life insurance there to buffer and allow your family to get over to the other side of the bridge themselves, that's what it's there for. So it's meant to be a bridge to wealth. It's relatively inexpensive.
Okay.
All right. And when I say relative, it's in relation to whole life insurance, which is oftentimes 10 to 20% more.
Wow.
Okay. What questions do you have on that, if any?
No, I kind of understand that right there. That was, putting layman's terms from it. So I got that. Yes.
Good deal. So then what we'll talk about later, but one of the things that isn't talked about a lot, and this has to do with salespeople will only pitch to you what they can get paid on, right? Think about that.
Yeah.
Right? You're not going to sit down with somebody who sell hamburgers and they're going to offer you a hot dog.
Exactly.
Right? It's not going to happen.
Exactly.
They're going to share with you why your craving can be satisfied with what they have to offer. And I'll take it a step further. The reason you don't hear about buy term, invest the difference as much is because the salesperson may get paid, but they're not getting paid handsomely.
Okay.
It's not even worth them taking you out to lunch or going out to dinner and things of that nature.
Wow.
It's not a very lucrative proposition for them.
Okay.
But that doesn't mean it's not what's necessary for you.
Okay.
So we'll talk about that more in a minute, but I just want to put that strategy out there. So you have term and then you have whole life. And I share with you already that term is about 10 to 15 times cheaper, or another way of saying that is whole life is about 10 to 15 times more expensive. And the reason for that is that cash value component, because a part of what you're paying to the insurance company it's really three ways your money is split up when you pay a premium, right? And it's a little oversimplification, but I think you get it. A part of it goes to the insurance company to pay for their overhead, okay, right? To keep the lights on and keep people employed, all of that stuff. Another part of your premium, the amount that you pay to the insurance company for the life insurance policy, is going to satisfy whatever profit margin that they have in mind for selling these policies. Okay. And then the other portion goes to your cash value. Right? Okay. Now, this is a more lucrative proposition for a life insurance agent, because if they get you to put away $10,000 a year into a life insurance policy, depending upon the company that they are registered with, they could earn in excess of $9,000 for you putting away in terms of a commission for you putting away $10,000.
9,000 the entire term or 9,000 per year?
No, 9,000 for signing you up essentially.
Wow. Okay.
Right. So if you extrapolate that out, if you put away $100,000, then they could earn $90,000 or $80,000. It's dependent upon who they are, with, and how the compensation is structured. And it's not just the money. If they sell so much of it, they can get free trips to exotic locations, right? It's a whole lot that goes into motivation. So the reason I bring that forward is it's important for people not to be flattered by the pursuit. It's like, man, they keep calling me, they must really want my business. Yes, well, they can spend 20 hours chasing you down. Is that worth an $80,000 payday for 20 hours worth of work? Right? So literally people get really flattered. Like, oh my gosh, I must be a big shot now because they're reaching out to me. They're showing up at my kid's wedding, they're showing up at relatives' funerals. I mean, sending flowers, everything. It's in anticipation of a huge payday.
Wow.
Right? So again, I'll just take a step back there. I just want to paint the picture and we'll dive into the specifics, but it's important to know the mindset going into it so you understand why they're so diligent in trying to convince you that it's the best thing since sliced bread. And then also why the pursuit is so hot and heavy when it comes to gaining you as a client.
Gotcha. Makes sense now. Makes sense. Makes a lot of sense.
So that's what we're looking at there. So let's talk about more of the specifics, right? So when you talk about cash value life insurance, you're really talking about the building of reserves by you paying more than you need to for the life insurance coverage, right? So, and what happens is the life insurance company takes your money, invest it on your behalf, take their cut, and give you a cut.
Gotcha.
Right? So you are essentially paying for something that you could do on your own. You're very capable of investing your own money.
Okay.
And I'm not talking about Warren Buffett style, right? Stock picking, things of that nature. I mean, you can put money into an S&P 500 index of the top 500 companies in the United States, just like anybody else can.
Exactly.
Right? And you don't have to give an insurance company a cut in order to do that. But what you do have to be is confident in the fact that even if the stock market goes down, it will go up. Because essentially what you're doing here, when you go through a life insurance company instead for them to invest your money, it's really because you're scared. So you're paying a scared premium.
Okay.
Right? You could do it yourself, but make me feel better. You can pay me less. I don't want to have to deal with the ups and downs myself.
Gotcha.
Right? So here's the irony of it, right? You'll see people online. I was just watching the guy the other day. I did a video about it. I did a video last night. I dropped it in. The guy gave the example of a 10% dividend payout. It's like, if you get 10%, I'm like, whoa. First off, show me an insurance company that's paying 10% dividend. They don't exist.
Okay.
I challenge anybody to post it. Put it in the comment section if you can find a life insurance company that's paying 10%. Matter of fact, I know not a lot of people maybe today, Earl, may be as familiar as maybe you and I, but are you familiar with Consumer Reports?
Yes.
Yeah. So Consumer Reports, very legit. They don't have all kind of bias wrapped up in their analysis. And what they found is that the average whole life policy rate of return, when fees and everything is extrapolated out, is 1.5%.
Wow.
So my question to you is that wealth building?
That's ridiculous.
is that building your own personal bank?
Man,
so keep in mind, but here's the interesting thing. Hello. So here's the interesting thing. is that people, nice. Hey, man, financial education starts early.
You're right.
So here's the interesting thing. People can almost illustrate, I'm not going to say anything that they want, but where people, get caught off guard is that they say, yeah, Joe, but they showed me in this illustration, well, I will earn this. Well, they can illustrate that you will earn something all day long. It doesn't mean that's what you will earn.
Exactly.
And if you notice on the illustrations, they have a guaranteed column and they have a non-guaranteed column with what you will make. They also have a maximum expense that you can pay and the current expense that you're paying. So you haven't seen worst case scenario. They're going to paint it all rosy and pretty. And then once you get into it, you're locked in for 10 to 15 years.
Gotcha.
Your money is in jail for that period of time. So if you put in $100,000 today into a life insurance policy, a whole life insurance policy, chances are you won't be able to get out or even break even on your cash value for 10 years.
Wow.
What kind of bank is that, sir?
That's not one I want to be affiliated with. I can tell you that.
Help me understand. So anyways, check it out. And by the way, there are some legitimate uses for cash value life insurance. But we have to first tackle these pie in the sky notions that there is some kind of secret society of the wealthy that a person tapped into, and now they're sharing the information with the masses.
Gotcha.
And you ought to show your appreciation by buying these policies from them, right? So check it out. Let's say you find an insurance company that's paying more than 1.5%. And let's say it's a pretty attractive rate of return. Here's the thing you should know about the dividend payments, right? The dividend payments of life insurance oftentimes aren't subjected to taxation by the IRS.
Okay.
So you know how with life insurance, they talk about all the tax advantages?
Mm-hmm.
So here's the thing. The reason it's not taxed by the IRS is because the insurance company generated the gains from their policyholders. So the reason it's not taxable is this. If you have a mutual company, right, a mutual life insurance company, which is owned by the shareholders, right? When you get a dividend, a portion of that or the dividend comes from a refund of you being deliberately overcharged for your life insurance premiums. So the example that I give is this. Let's say you want to buy an iPhone.
Yes.
iPhone costs, I don't know, let's for round number sake, $1,000. And you walk into an Apple store and they say, Earl, if you buy this iPhone for $1,000, the latest model, we're going to give you a $10 refund. But if you buy the same model for $1,500, we're going to give you a $15 refund. Which one would you pick?
Well, the $1,000 one, because
Exactly.
it makes no sense. Yeah.
Right. So that makes all the sense in the world. But here's the problem. When you sit down with a life insurance agent, they're not going to present you with those options.
Yeah.
So you won't even know that you're overpaying for a premium unless you are comparison shopping. What you will know is that they are only going to point out to you what they want you to focus on, kind of like a magician,
Gotcha.
right? You know, the whole sleight of hand trick is the fact that they direct your attention so you don't notice what's really happening.
Gotcha. With
whatever object they're trying to make disappear.
Okay.
So in this case, they'll just say, Earl, savings accounts are earning 2% or 1%. How would you like to earn 6% on your money inside of this life insurance policy?
Exactly. Not
telling you that a large portion of what you're earning is just a refund of what you overpaid to begin with. All right. So talk to me a little bit. I've said a lot, but I'm looking in your eyes and it sounds like, I could be wrong, but maybe you've heard this, you've watched it, somebody told it to you in terms of how great these dividends are, but have they ever explained it the way we
No one has ever explained it. So I was in the midst of trying to comparison shop between two different people. But like you said, I mean, been constant calls, text messages. Earl, let's get on a call, let's get on a Zoom, let's get on a live. We can go ahead and wrap this up for you. Something you want to do for your family. Giving you all these things. Giving you all these roses, but not telling you about the thorns that that needs to be clipped off. So, exactly. I mean, I truly, I'll be honest with you, I've never heard it explained like this before. And everything you hear is to the contrary. It's just all the wonderful things that come from buying these policies. And then you hear, like you said, those who have found out, and this is what the rich do to get richer, and they never borrow money, they just use their own money. But like you said, I mean, what good is it to make 6% off your money if that's what you overpaying? So I mean, you're really not getting any money. So it would make more sense for you to go out and invest your own money versus putting it in there. It's what I'm hearing and what I'm trying to understand now. So
yeah, no, that's exactly it. So it's a combination of them giving you dividends that are a refund of you being deliberately overcharged, and also a combination of them investing the money that you gave them and them giving you a portion after they take their cut.
Exactly. And look, like so, they get the larger cut.
Of course.
By far,
right?
Yes.
Of course. So then you'll oftentimes hear like I was watching in preparation of this, I'm like, what are they saying on social media? So I was listening to, did you see that Waka Flocka video where he said, if I had 2-3 million, I would put it inside of a life insurance policy, so on and so forth?
That's exactly right. That's exactly
yes. So one of the things that I thought to myself is he must have talked to a life insurance agent first and foremost. I'm glad it sparked a conversation about financial literacy, but what it didn't do is give people the real picture in terms of, first off, he didn't make $2 or $3 million from having life insurance, right? He didn't say, hey, I got this 2 to 3 million from life insurance. He said, I'll take this 2-3 million and I'll put it into life insurance, right?
Exactly.
Which I don't think that makes sense. And we'll talk about that just a teeny bit. But again, it's important because everyone makes like it's this magic thing, but it's not going to fund itself. You have to be the person who whip up the money.
Funding, exactly.
Exactly. So we'll talk about that in a second. But then you'll hear about policy loans, right? How you can take money out of it tax-free and things of that nature. That part is true, right? You can take money out if it's structured properly for policy loans. But what I hear people saying is that, even if you take money out and then you use it to invest in a business and that money doesn't work out, no worries. It'll just come out of the death benefit when you die. So no harm, no foul. Right?
Yeah.
Well, a couple of things. One is that it's not you having your own bank and creating an infinite banking scenario. You know why? Because you're using somebody else's money and they're charging you interest for this money. Mm-hmm. So what does that sound like to you, sir?
Sounds like a loan. Yeah.
Regular loan, right?
Yes.
And so, and what they don't say is if you don't pay the loan back, it will eat away. And if your loan or if your policy isn't structured correctly, it could cause your policy to blow up in the future.
Wow. Okay.
So there's plenty of people who bought these kind of insurance policies because people illustrated a nice rate of return and all of this, and they took money out and didn't think they had to pay it back. And then it gets to a point where either they have to pony up a huge sum in order to bring it back into compliance, or they have to surrender it. And if they surrender it, then all those tax advantages go away.
Gotcha.
And that money that they took a loan on becomes, anything over the principal amount becomes taxable.
Taxable income. Okay.
Right. So just to give you an idea about, because some people are like, well, that won't be me. Okay, well, great. So look at life insurance this way. It's like a marriage until death do you part. Now think about that. The statistics are almost the same. Okay. Between somebody getting married and staying married and the likelihood of them getting life insurance and keeping life insurance.
Okay.
Pretty much everybody knows that there's about a 50-50 chance of people staying together forever.
Gotcha.
right? And if you look at according to the Society of Actuaries, 45% of whole life policies are surrendered in the first 10 years, 30% in the first 3 years. Now, it could mean because they figured out, like, man, this thing is not what I thought it was.
Yeah.
It could also mean that maybe life events happen, like they lost their job and they had to choose what to continue to pay and what not to.
Yes.
Or any number of factors. But here's what I know. You remember I told you that your money is locked up for the first 10 years in most situations? The reason being is because the life insurance company is extracting their profits, recouping their costs for administering the life insurance policy, and making sure to recoup their costs for the commission that they pay to the person who sold it to you.
Gotcha.
So that's why if you ever looked at an illustration, oftentimes it will show your cash surrender value as being 0 in the first year or two.
Mm-hmm.
Ring a bell at all?
Exactly.
So if most people are surrendering, or 45% in the first 10 years, that's before oftentimes they're even out of the surrender period, which means not only is it not a bank, but they're getting back less than what they paid into it. And if they surrender 30% surrendered in the first 3 years, they sure in heck aren't getting nearly what they put in.
Exactly.
All right. So tell me how much of this rings true based upon your experience so far.
Yes. I mean, man, 100%. Like you said, but it's just omission of the truth just by not saying, I have not had one agent to explain this. And I've had whole life, all my life. And then, after I finished college and, got my own policies, got my family policies and things of that nature, but no one has ever explained it the way you're explaining it now. And it makes sense now, different career, looking at increasing, we're thinking about increasing. And, when you start speaking to people, they just start running you down. Once you start speaking numbers and saying, this is what you were thinking about. And it's like, oh, okay. Yeah, we definitely can help you out with that. And so, it makes 100% sense now why they're so eager to, get your business.
Yeah, and those numbers look amazing, right? But that's compared to what?
Exactly.
That's what you have to think about, because they'll show you these illustrations. Like if you put in this amount for 10 years and 30 years, you'll have that. And you're like, oh my gosh, that's more than I ever thought I would have.
Yeah.
But do they ever give you a comparison between that and if you were to buy term insurance and invest the difference in how much you would have? And then you can really see, oh, I might have 5 million in 30 years, but I could have 10 million in 30 years if I would do it this way.
Exactly.
So along those lines, right? So give you an example of what that looks like. So if a person, right, had a $1 million life insurance policy, and let's say they're 30 years old, right? Mm-hmm. Average health, they could get a $1 million whole life policy, maybe starting around $850 a month. Okay. Now they could get a $1 million term policy, and I did a 30-year term policy example.
Okay.
Right, for $65 a month. Okay. So that means that if a person bought term insurance, paid $65, and they had the $850 to invest or to take care of their financial situation, then that would leave them with $785 to invest. With me so far?
Yes.
So if they invested at $785, earned an 8% rate of return over 46 years, what would that money grow to? Well, first, where did I get 46 years from? The average life expectancy for an American male is 76 years old, right? A lot of people think it's a lot older, right? So if a person is 30 years old, then conceivably they have 46 more years before the life insurance would pay out. before that $1 million life insurance policy would go to their heirs. Because now the biggest thing is people are taking the whole generational wealth thing and using it in their sales pitch. Well, Earl, I know you want to leave generational wealth.
Exactly.
This is a way to do it. So let's compare. So in 46 years, assuming an 8% rate of return, that person would have had $1 million term coverage for 30 years. And at the end of 46 years, they would have 4.5 million. Now you're a smart person, Earl, so you may say, well, Joe, why have term insurance for 30 years versus 46 years, right? The reason I ran a 30-year term is because that's enough period of time for that $785 a month growing at 8% to equal $1 million.
Gotcha. Exactly.
So why would you need life insurance after that to pay out for $1 million death benefit?
Exactly. When you've already accumulated that from just investing your own money.
You got it. But you had that wealth bridge, right?
Yes.
You had that wealth bridge because you didn't have that million to begin with.
Exactly.
It took you 30 years to get it in this
Gotcha.
example. So you would have had life insurance protection for 30 years for $1 million if something happens to you. And at age 76, your family will get $4.5 million, assuming an 8% rate of return, or $9 million, assuming a 10% rate of return.
Wow.
Versus, right, your family just getting $1 million at age 76. Because what a lot of people don't know is that if you grow your money to, let's say, $800,000, your cash value inside of your life insurance grows to $800,000, and you have a death benefit of $1 million, your heirs are not going to get your cash value plus your death benefit. They're going to get your death benefit.
Mm-hmm.
So the insurance company keeps your $800,000. Thank you for saving diligently. We get to keep this money. You get the $1 million death benefit. And if there is an insurance policy that is structured differently, then you're paying for that too.
Gotcha.
So if you told a life insurance person, like, I don't like this, oh, no problem, Earl, we'll illustrate that you get paid both. You'll just have to pay more money. You have to buy more insurance essentially in order to achieve that. So, and then people will harp on the fact that, well, life insurance death benefit in most cases are federally income tax free. What most people don't know is that right now, let's say for illustration's sake, let's say you have $4.5 million in Amazon stock.
Okay.
And you passed away yesterday. Your heirs, if you're the only person that owns that money and you leave it to your wife, she gets a step up in cost basis. And what that means is if you put in $1 million and it grew to 4.5 million and she turn around and sells it the next day, she doesn't pay any taxes on that money.
Wow.
On that growth. If you were still alive and you sold it, you would pay taxes on that growth from $1 million cost basis to the 4.5 million that it grew
Okay.
to. Now, I can't give tax advice. I can just tell you how it works.
Exactly.
All right. So again, this is a very simple comparison to say, okay, $1 million generational wealth by you buying $1 million whole life policy and paying $850 a month, or spending that same $850, divvying it up, having a life insurance bridge for the first 30 years. But then if you pass away at age 76, your heirs get 4.5 million.
Gotcha. Gotcha.
Which would you prefer? Generational wealth of 4.5 or 1 million?
Oh, come on, man.
I'm just saying, right? But that's the importance of comparison, right? I always tell people the benchmark matters, right? Because if we're comparing whole life insurance to doing nothing, then okay, sure. I mean, it's better than doing nothing, but is that really how we go through life?
Exactly.
Or do we say, is that the better option or the best option? And compare it to something else that's just as good, if not better.
Yes, I agree.
All right. So again, I want to give you an opportunity to get all the questions that you have out, because it's not only hopefully going to help you, but help other people who are watching and listening to this who are in a similar situation as yourself, right? Trying to figure it out, being pitched a one-sided pitch, right? And trying to understand a 360 view, because you know you're smart, but you also know you can't make decisions without having all the information.
Exactly. So
Right.
this makes a lot of sense now. And now that I look back at it, I had a gentleman that tried to come in and sell me some insurance. And he was speaking term. He was like, you get this term insurance policy, you invest your other money and then it grows. And so really you should not need this insurance at your time of death if you live and you invest properly. And I'm just like, this don't make sense, because, in my mind, I've always been taught, as a child growing up, you got to get a whole life policy and this, and, that's what takes care of you when you die. And so no one had ever educated me on the fact of, you get your term policy, you take that other money, what you're talking about now, invest. And so that money is your nest egg, not only when you die, but you will have that money. So if you want to do something before you die, so you can enjoy and reap the benefits of your labor. But so I completely just dismissed this guy because I was like, man, dude talking crazy.
And everybody else was saying something to the contrary, right?
Yeah, that's exactly right. So it was one person saying that versus everybody else saying something totally different. So, I went with the masses versus going with this one gentleman. And now, speaking to you, probably 7, 8, 9 years later, he was the one that was accurate. You know what I mean?
Yeah, and that's the thing, right? And the other thing I will say is that, let's say he was right on the term, right? That doesn't necessarily mean, and it doesn't rule it out either, it doesn't necessarily mean that you should also invest the difference with that person.
Got you. Exactly.
Right? Because think of it this way. You know how banks will offer you a free checking account? Right? Or sometimes they'll say, we'll give you $200-$300 if you sign up for this checking account.
Exactly.
That's called a loss leader. They know they're going to lose money on that, but they're going to sell you something on the back end that's going to more than make up for that.
Got you.
So if they put you in term only to put you in very expensive mutual fund investments, then it's the same thing.
Gotcha.
Okay. But if you invest in term, which it sounds like that gentleman was on the up and up, bravo to him, especially as you know the pay difference between him selling you term and him selling you whole life. Exactly. Right? Bravo to him. And then you invested in a low cost carrier, right? Like Vanguard would be an example.
Okay.
Very low fees. And that's what we're trying to do here, right? We're trying to minimize fees as much as possible.
Yes.
And then what happens, and then for the majority of people, this doesn't work for everybody, but, well, yes, it does. It works for most everybody. You will want to start off putting the first $6,000, right? And if you have more to invest in that, great. But the first $6,000 go into a Roth IRA.
Yes.
Now, a lot of, people will say, and my career is wealth management. So all my clients were wealthy. So most of them didn't qualify income standard wise for a Roth IRA. And that makes people feel good oftentimes. Well, Joe, I don't qualify for a Roth. I make so much money. Well, good for you. But if you have the right person advising you, you would also understand that anybody can put money into a Roth IRA.
Backdoor.
What is known as the backdoor IRA. Right? So you put your money in a traditional IRA, turn around, move it from a traditional IRA into a Roth IRA, pay whatever taxes on the growth. You're doing it in a week's time, 2 weeks' time, 3 weeks' time. It's not going to be much growth in it. And you found your money into a Roth IRA. So now that money is growing tax deferred. And when it comes out on back end after 59 and a half, it's tax free. Just a little side note.
Yeah.
Right. And then everything else goes into a low cost index fund like the S&P 500 index or something of that nature. right? That's what Warren Buffett suggests.
That's exactly right. And look
And
at him.
so,
Yeah.
so that's what we're looking at. All right. I got a few more tidbits, but I just want to make sure I'm hitting the mark when it comes to what you would hope to get from today's session.
Precisely, brother. You got the scope dialed in. Precisely.
I love it. I love it. So then it becomes, it's like, okay, Joe, like how do I explore coverage and pick what is best for myself, right? How do you explore coverage and pick what is best for you? All right. So a couple of things. I'll take you through about maybe just 3 different ways in which you can approach it.
Okay.
All right. One is you always want to look at, as I said before, where's the conflict of interest? And I don't like conflicts of interest when it comes to my money. I want the person to solidly be on my side of the table. But what that oftentimes requires is for you to hire somebody on a fee-only basis.
Mm-hmm.
And the problem is people are adverse to that a lot of times. Now, they will pay $850 a month into a life insurance policy that has 0 cash value for the first 1, 2, or 3 years, which means that money is going to pay your insurance agent as well as the company.
Exactly.
But that doesn't feel as painful to people as it would to pay someone $200 an hour or a $1,500 fee in order to analyze their overall situation.
Exactly. I agree.
Penny wise and dollar foolish, right? Or maybe dollar foolish and however the reverse, because you're paying a lot more just to not have the pain of writing a check.
Exactly. Exactly.
All right. So I suggest people to get with a fee-only certified financial planner.
Okay.
The certified financial planner designation is the gold standard, right? The amount of rigor that people have to go through in order to achieve that. I am a certified financial planner, so I know the process. And I know that after taking 2 years of high-level coursework, and in my day, we had to take a 10-hour exam that lasted over 2 days. And it's applied knowledge. So it's not regurgitation. Applied knowledge is more akin to the bar exam. So I think this number is still true today, is that less than 50% of people pass that examination.
Wow.
For that fact of it's so rigorous. So that's a certified financial planner is steeped in knowing not only what's available, but picking the best option of what's available.
Gotcha.
And then you want that person to be fee only.
Yes.
Now here's the wordplay, Earl. You will hear fee only, and you will hear fee-based financial planner.
Okay.
It is very easy to think that they're one and the same. Fee-only financial planner means they only get paid by you paying them hourly or paying a fee or assets under management. I prefer the hourly or the fee myself.
Gotcha.
But a fee-based planner can get paid a fee as well as a commission.
Okay.
That's the importance of a fee-only planner. And if you're looking for one, National Association of Personal Financial Planners is a good place to start.
Okay.
All right. So when I break it all down here, the difference between a fee-only and a fee-based. All right. And like I said, there are legitimate uses of cash value life insurance, things of that nature. However, you want to work with a financial planner who can assess your overall picture to know, is it best for you to have to buy term invest the difference, which to be honest with you, 99.9% of the time, that should be what a person is looking at.
Gotcha.
Right. If a person has a disabled child and, lawsuits, things that even with lawsuits, I mean, you can buy an umbrella insurance policy from the same place you have your car insurance from, and that gives you much cheaper protection than buying a life insurance policy for it.
Okay.
Right. Estate planning, things of that nature, that doesn't apply to, most people. right? Because you can pass over $12 million per person to your heirs without paying estate taxes.
Wow. Okay.
And most people aren't worth over $12 million. And they certainly, most people aren't worth over $24 million as a couple. Right. So anyways, digress on that for a moment. But the importance of helping a person or getting a person to help you is that I just used the blueberry example. Not all insurance companies are bad and not all life insurance agents are rotten. However, if 95% of blueberries in your pack of blueberries are rotten and there's only 100 of them, are you going to wade through all that mushiness and all that, or are you going to look and say, you know what, that's a bad container of blueberries. Let me go over here and look at something different.
That's exactly right.
Right. If you wanted to go at it alone, that's fine. You can do that as well. Some of the figures I got today for like that $1 million life insurance policy came from this, quotacy.com, online life insurance broker. They have a A+ rating with the Better Business Bureau. I don't receive any compensation for anyone using them. Use them or don't use them, but that's who I use for some of the quotes today. If you're looking for a rule of thumb, it's really more, I put 5 to 10, but most people nowadays says 10 to 15% of your income, right? Is a rule of thumb. So if you make $100,000 a year and you're looking to see how much life insurance that you might need, could be $1 million, $1.5 million. And in terms of how long you keep that life insurance, that term insurance, is based upon, looking at your largest debt. So if you have a mortgage of $400,000 and that's your largest debt and it's going to be paid off in 20 years, under this rule of thumb scenario, you would need a 20-year term policy.
Makes sense. Okay.
Or if you want to get more detailed and specific and you're doing it yourself, DIY, you can do the calculation. How much would I want for burial expenses? If you were to die yesterday, how much income replacement would you want? Would you want to replace your existing income until your kids are out of college? Would you want to replace your existing income for the first 10 years to allow your family to get on their financial feet? Is there debt you want to pay off? Is there childcare that needs to happen? All of those different kind of things where you could calculate your life insurance need more specifically if you wanted to.
Makes sense. Makes a lot of sense now because, like I said, none of that had been explained before. The reason why, you want so much insurance and then the time period that you want it for.
Yeah, for sure. So that's key. And then you want to look at the life insurance company because look, if you pay into something for 20, 30 years, you want to make sure that if something happens to you, they're going to be around to pay that death benefit.
Exactly.
So these are the 4 major rating agencies when it comes to financial strength, right? Because a life insurance company is promising you, it's not FDIC insured like a bank account.
Yes. So
it's based upon their wherewithal financially to, come through on their promise to pay that death benefit. Here's another thing I'm sure that they didn't tell you when it came to cash value life insurance is that in most states, every state is different, but in most states, if a life insurance company goes out of business, the first $100,000 of your cash surrender value or your cash value is covered. So if you're like Waka Flocka in that scenario, and you put $3 million into a life insurance policy and that company folds, then we're looking at you walking away with 100,000 and losing 2.9 million. All right. Now people can point to, it's not likely, things of that nature. Yeah, sure. Right. Okay. Well, there were also companies there in 2008 that had good financial, ratings. There were bonds that had really good financial ratings, and that sent our economy into a tailspin.
And it's funny that you said that. I was actually, before we got on, I'm watching that now, the documentary on Inside Job, and that's what they're talking about, the financial market and issues that happened in 2008. Man.
Yeah, because the rating agencies get paid by who?
Those people, those companies that they're rating. Yeah.
Exactly. So if they give them a poor rating, are they going to get that repeat business?
Not at all. Not at all.
Right. So hopefully they fix that problem, but we know that it reared its head in terms of that conflict of interest in 2008.
Yes.
Right. So I think that when you look at it in totality, right, you think about you can hire a fee-based planner, you can go at it yourself, right? Or you can do nothing, which I don't believe is an option, right? Because like I said, I am a proponent of life insurance. And matter of fact, I wanted to put this up, right? You have all these different companies, right? But what I wanted to share with people is you see Guardian down there, and I put in parentheses HIV. Because far too often people believe that they don't qualify for life insurance for one health reason or another.
Gotcha.
Right. And there's plenty of companies that will insure people. And again, we talked about the benefit of being term insurance.
Yes.
Right. That will, turn around and insure people. And again, there's certain life insurance companies that specialize in certain areas. Guardian have a propensity and have experience working with folks who have HIV. There's companies that work with smokers. There's companies that work with all different kind of folks, because the problem is the fact that less than half of Americans have life insurance. But part of that problem is because they know, that if they go meet with a life insurance agent, that they don't feel like they're getting the full deal.
Mm-hmm. That's so true.
So they just avoid it. I don't feel like going through that. Somebody calling me all the time, texting me all the time, let's get the deal done, right? Most people don't want to have to deal and contend with that. So sadly, what that results in is people not having it at all. And that's not what I'm saying the least bit.
Okay.
I'm dispelling the myth around creating your own bank, that the cash value is better than you, buying term and investing the difference, because it's not.
Yeah.
Right. And anybody worth their salt will tell you that if you have the discipline, that's precisely what you want to do. Right.
Yeah. Yeah. I definitely appreciate it, man. I mean, I feel so much better now to have it explained to me. Because like I said before, it was just, everything was roses. I'm handing you this rose, but nobody talked about the thorns. And so, this really, now gives me clarity on what I'm going to do as far as the insurance piece. Yeah, definitely.
Good deal. So you know where you can go to get a fee-based certified financial planner. You know where you can go if you want to do it yourself, or you can look at Codacy or their competitors or whoever makes sense, right? To look up some things of your own. And you know what? The nice thing about it is you can Google investment calculator. You can see, okay, for kicks and giggles, you can probably look at the illustration that you were given that they want to button up, and you can look to see, okay, here's how much they're saying that I should pay into it. Yeah. But here's what I could do if I just invested that money, earn an 8% rate of return at X, Y, and Z. Exactly. And by the way, I should tell people that you may not be able to see the difference between what you're paying or what you would be paying in a life insurance cost versus what's going into your cash value, because most life insurance agents leave out what is known as a cost of insurance page.
Wow.
Right? Because again, it's the sleight of hand. I want you to focus on this. So why would I put something in there that's going to derail myself?
Exactly.
That a person may look at it and be like, oh, that's how much is going towards insurance, especially in my latter years.
Yes.
So one of the things that I wanted to make sure is that you got a true 360 view, right? Is there anything that we haven't covered today that you feel like it would be beneficial for us to go over to give you some additional perspective?
One final question that I've thought about for some time now. I'm 46. I'll be 47 in December. and I know you retired at 38. How can I at 46 retire at 38?
I love it. I love it. All right. So I can't go back in time, but what I can do is tell you, that simply put, I'll tell you this. Without even, it wasn't on purpose. I've been a saver my whole life.
Yes.
Right. That's different because, everyone sees folks who are being super cheap and that's how they retire early. They're rolling the last bit of the toothpaste out of the toothpaste tube and all of that. And that has its place. That wasn't my scenario.
Okay.
I traveled, I had luxury cars, nice neighborhoods, all of that. But I still saved 60% of my income.
Gotcha.
Or over 60%.
Okay.
Right. So for people who want to retire early, it's really as simple mathematically to say, I'm going to save 60+%, the more the better, for as long as I can, put my head down for, 3, 4, 5, 6 years. And I'm going to invest it in a low cost investment like a S&P 500 index with Vanguard. And I'm going to let that money ride.
Yeah.
Okay. And how you know if you are close to your goal is all you have to do is anticipate what your expenses will be in retirement. So for example, if you say, you know what, I need to have $100,000 in order to feel comfortable. Multiply that by 25 and you know that you need to have at least $2.5 million in investments for you to fund your lifestyle.
Gotcha.
Right? If you need 200,000 and you know you need 5 million. If you need 50,000, you need, 1.25. You understand what I'm saying? So it's very easy to calculate your FIRE number, right? Your financial independence, retire early, and then invest over 60% of your income. And invest is the key, not save, invest.
Yes.
And you'll get there sooner rather than later.
Gotcha. Well,
you can't go backwards. It won't get you to 38.
Hey, I was hoping you could answer that question from me, but you know what? You gave me the next best thing. So
that's what's up. Hey, brother. Well, I appreciate you, joining. When I share with you, like, hey, I like to do it so people could be fly on the wall.
Exactly.
And I promise you that I would make sure that it's equally as beneficial to you. Did I fulfill my promise?
Oh, you did. Beyond your promise. Yeah, I certainly thank you, man.
My brother.
Appreciate it.
Yeah, absolutely. Well, appreciate having Earl, everybody. I appreciate if you enjoyed this session, you'd like to see more of these kind of Ask Joe segments. First off, leave a comment in the comment section because I will pull from those for people who want to join me in the future. And then please like, share, and subscribe so more information or as many people as possible can get the information that we shared here today, because as I suspected and that Earl confirmed, it's not being pitched when people are out there sharing with you the ins and outs of life insurance.
So cool.
All right. So until next time, everybody, be good to yourself. And Earl, I'll talk with you later, sir.
All right, my brother. Thank you so much.
Right. Yes, sir. Take care.
All right. Bye-bye.